All right, traders. This is going to be a nice and well-needed conversation. So, 7 things I wish I knew when I started trading. This is me really talking to my younger self, or myself when I first started trading, which was 3.5 years ago. So I started trading in 2019. Yeah, 2019. So this is what I told myself if I could go back in time. So, one, the markets are 100% controlled. You want to find the right mentor, intermarket correlation, true day, liquidity pools, liquidity voids, and SMT. These are all the things I'm about to dive into. So we're going to take them one bit at a time. All right. So the markets are 100% controlled. The markets are not free for all. The central banks control everything. I'm better off understanding the mechanisms of how they operate inside of the marketplace instead of trying to reinvent the wheel by using indicators, trend lines, chart patterns, etc. Those are all subjective. However, when you trade with ideas of liquidity pools, liquidity voids, just to mention a few, they are objective in nature, right? Now, I'm not here to knock anyone that trades the trend lines and indicators, all that stuff. If you are truly finding profitability with that, good. But if you're not, erase all that nonsense off your charts. It's a waste of your time. There's better ways to trade the market and to actually understand the market. I've done all those things before, so like I said, I'm not trying to downplay anyone that feels like the trend lines is the shit. But think about it. They're teaching. Think about it. 90%, the stats is supposing that 90% of traders lose, right? And only 10% survive, really. That's the stats. But think about it. If 90% lose, right? Since for there to be a loser, there has to be a winner. Who's winning 90% of the time? If there's a 90%, if the retail trader loses 90% of the time, who's on the other end of that that's winning 90% of the time, right? And then only loses a few times, just because they just give it away. Think about it. So you didn't want to be on the side where every book talks about trend lines. Everyone knows about trend lines. Everyone knows about double bottoms. Everyone knows about Gartley patterns and, Elliott waves and all kinds of stuff. But like I said, if they're not making you money or you're a 50-50 trader, you can do better than that. Take that off your chart and for a second and just pay attention to what I'm about to say and stuff I'm about to talk about. Right? Those chart patterns seem easy and fun to trade, but they are a waste of your time, Casey. So, the markets are not free for all. It's not that buyers push the market one way and sellers push the market one way. The markets are going to do whatever they want to do. What do I mean by that? If, for example, Goldman Sachs wants to get into Euro USD at a certain price, just because they got in and put on such a large size does not mean that they push the market higher. Their volume does not push the market higher. If they sell at that level, if the market goes lower, the volume does not push the market lower. It's just an algorithm that is controlled. Controlled by who? The central banks. It's controlled by AI. Artificial intelligence. That's what's moving the market around. Not because of buying and selling pressure. Not because of supply and demand. The markets are not free for all. It's a rigged game. All right, so now I'm going to touch base on the right mentor. See, I wasted a lot of money by paying mentors that just showed off this lifestyle on Instagram. And I believe that they were profitable. I believe everyone's profitable till you pay that one mentor and you realize this guy doesn't know what he's doing, right? So 90% of these gurus and mentors, okay, give me 1 second. So 90% of these gurus and mentors on Instagram cannot trade at all. They sell you the lifestyle. There's what you call empty for rented servers, which is just pretty much I could pay for them and essentially manually put in where I enter the trade and where I exit it just to show profitability. So a screenshot of the MT4 account alone does not mean that your mentor is actually profitable. A lot of them are just lying and have rented servers. You want a mentor that actually lives and breathes the markets and that shows consistency, right? A lot of these mentors made their money from selling courses, not actually trading. You want a mentor that's not only teaching hindsight, but also current events, or also teaches foresight. So you want a mentor that can show you stuff on the charts that repeats. Someone that actually cares about the markets, someone that's always on the markets. A real mentor should always be concerned about what's going on in the markets. Always. And also, whatever they teach you should be able to show itself on the charts without a doubt. You see, what happens is we learn from all these people, and they teach us things that are highly subjective, like trend lines and RSI crossovers and all those stuff. It's harder for you to back test those things. And on top of that, a lot of these mentors, even if they are using those things, which they are not, I highly doubt it because they're not profitable, it's good to have a mentor that also shows you strategy and teach you how to apply it. You need to know how to apply something, because for there to be a strategy, it means someone created it. The author of that strategy, you can read it. You can read the manual of a book, or you can read the manual of the strategy. But without the author really showing you how to really apply it, when not to apply it. Those are all the things a real mentor, a right mentor, should have in his bag. All right, so the right mentor is important. Now, right now, IML is not trending, or MLM is not trending. I will stay away from that like I did. I was pushed to get into it one time, and within a week, I got out quickly because I could not recruit people and teach them how to trade when I was still learning how to trade. That's the nonsense that goes on. The blind leading the blind. So if you're an IML or MLM company, if you learn how to trade, you're not going to know how to trade from those people at all. 99.9% they cannot trade. If you're that 0.1%, then you know yourself. But for the most part, they cannot trade at all. It's the blind leading the blind. They're only in that thing just so that you can be under their pyramid so they can get money. They want you to pay $150 a month. Stay away from that foolishness if you really want to learn how to trade. And I did a good job by staying away from it. Good job. Now, at the same time, with these mentors, I want to talk about how I was able to figure out my own mentor. Luckily, as much as these mentors didn't teach me nothing, I happened to be in one mentor's group and someone mentioned ICT. And from there, that's how I searched him up, watched all his videos on YouTube, and waited. He dropped his mentorship. I got his paid mentorship, and that was the last mentorship. So, luck, coincidence, whatever it is, I thank God for it. So, as much as you want to be careful what mentor you're paying. From my little experience, as much as I paid a mentor, I wasn't teaching much. I was able to figure out a whole new mentor just by being in that circle. So, don't let Instagram, flashy cars, and all that stuff fool you. It's all a game. There's a lot of them that were doing that. Their accounts got shut down. They're gone, off the map. Because it wasn't built on no rock. It was a shaky foundation from the jump. And they were fraud from the jump. I've paid money. I've paid almost $5,000, if not more, trying to learn this game from a lot of these fools on Instagram, and none of them could trade. Long story short. Now, on to the next. Now, that's the word going to get more technical. Now, we're going to dive into the chart. So, if you're listening, stay in. We're going to dive into the chart. That's what everyone wants to do. But these parts of your lecture, of your development is so necessary. You might overlook it. You shouldn't overlook it. These are things that matter. Right? Not just going to the charts and seeing everything technical. Those matter, but you got to lay down foundation. Okay, so intermarket correlation. You need to understand that the markets are all interconnected. Currencies, commodities, stocks, bonds. You should be paying attention, or at minimum, understand what is going on in each market at any given time. A mistake traders make is just focus on one pair only, or multiple pairs, actually. that are uncorrelated, just trying to catch a yield, just trying to make some type of money. Stop being in a rush to make money. Your vision will be very short-sighted if you do this, and you will have no clue why your winning trade quickly turns to a loss. And also, if you, like I said, are trading multiple asset classes, just trying to catch yield, your vision will be strained. When dollar goes up, this is important. The dollar is king of the market. So when dollar goes up, when DXY goes up, foreign currencies, commodities, and stocks should go down. Correlated pairs should be doing the exact same thing. When they deviate, this is a sign that there has been an underlying shift in market, and smart money is more than likely interested in that market. So now, dollar is king. Understand this. Dollar is king. Understand this. If you're just looking at one market, let's just say you trade Euro USD, and all you do is look at Euro USD, you never look at dollar, man, you're playing yourself. You can make your little money here and there, but you're playing yourself. Wouldn't it better off for you to understand both sides of the spectrum so you know when to execute a trade and when not to execute a trade? Right? If dollar is supposed to rally for the day, and euro, you see it rallying a little bit, just because of your chart pattern, you know, and then all of a sudden now you're in a losing position, right? Because you didn't pay attention to what the dollar was doing, and you're wondering what happened. And you're just looking at your charts, looking at your little patterns, trying to see how you can get back into your buy. Meanwhile, if you understood, this is, to me, the fundamental part of the market. If you understood what the dollar was doing, you'd be able to understand why euro is doing what it's doing. So, you need to pay attention to the dollar at all times, if anything. That's number one. The dollar's king. Interest rates is king, but that's the whole nother story. But the dollar, when we're talking about intraday trading, the dollar is king. Whatever the dollar does, the market tends to do the opposite. Okay? So if the dollar's going up, we're in a risk-off situation, which means commodities, stocks, currency should be dropping if dollar's going up, and vice versa. If dollar's going down, they should be rallying. Okay? So these are essential for you to understand. Do not just focus on one pair, and do not focus on too many pairs, because then you'll be too short-sighted. You need to understand what is going on with the dollar at all times. That way you have confidence and ability to stay in your trades, and if you get kicked out too early, you hop back in. Or you're able to hold your trade longer instead of just trying to close out as soon as you hit your first take profit level. And that way you have more confidence in your trade. I mean, that's all. Really, it gives you more it boosts your confidence, so that when you do see your pattern, now you have a fundamental thing behind it. You're able to take the trade with ease. And if you get stopped out, you look at a dollar chart. Maybe you see something and see a reason why you got stopped out. So it's important. You know, I've talked to some traders, and they think they can just trade the market by just trading, looking at one currency. Good luck with that. Now, you could make some money that way, but like I said, why shortchange yourself, right? You want to know what's going on in the markets at all times. We're traders. We're not just stuck to one asset class. We're traders. Trade currencies, trade stocks. I don't trade cryptos right now, but trade cryptos. Trade it all, right? But at the same time, do not be just too short-sighted. All right. When I say trade it all, just pick a couple pairs and trade it. Just know you can trade the stock market, which is the indices, which is what I trade, and also currencies. So, dollar's king. Dollar's king. Pay attention to that. That's why some of your trades are probably failing or not taking off when they should take off. Now, true day. So, I wish I had known. Oh, let's talk about it. The true trading day starts at midnight New York time and ends at 4 p.m. Drawing a vertical line on my chart at this time of the day will give me more clarity on what the market is likely to do. Then you have the kill zones, which is London session, New York session, and Asia session. Most volatility is seen in New York and London session. Just totally forget about trading Asia session. So when I was younger, I keep saying younger, I'm only 24. When I started trading, It's like a rush. You want to trade every second you can because the market's open 24/7. That's what they tell you. It's open 24/7. You can make money whenever you want to make money. Just get in there, place a trade. You can make some money. No. Asia session is a consolidation for the most part. Back and forth. Why would you trade in a market that has no direction? It's stressful. It's less volatile, which means it's not moving around. No one really cares about that session. Nobody. Now, I'm not saying that it's not times you can make money. There are some pairs that do work with Asia session, but for the most part, you want to be in the most liquid markets at the most liquid times, which is during New York time. During a New York session, which is from 7 a.m. New York time to 11 a.m. New York time. And then London session starts today, actually, 2 a.m. New York time to 5 a.m. New York time. You know, from 2 a.m. to 5 a.m., that's London session. Then at 5 a.m., London trades go on a break. And then they keep on trading by 7 a.m. all the way up into 11 a.m. New York time. So, anyways, London from 2 to 5 a.m., that's your London session. Then you have the crossover for New York session, 7 a.m. to 11 a.m. Those are the times you want to trade the markets. Don't just think it's a sugar rush. So you can just get in there and place a trade during Asian session and expect it to play out. Look, your pattern might be there. It might be a very strong pattern. But at the same time, if it's on a likely time, it's going to fail. It's going to lose. So you want to avoid losing. It's about capital preservation. Get out of this mindset that you think it's just all about making money. It's about risk managing your capital, staying in the game long enough so you can actually see the fruits of your labor. Everyone, when they start trading, just wants to make some money. I get it. Demo trade as long as you can. Don't let anyone fool you or think that they're better than you because they're trading live and they're not even making no money. And you're demo trading. You're understanding the game. You're doing it the proper way. So, demo trading is what you need to do. Don't rush into trading live funds when you're not ready. You must go over your charts. You must have back tested your charts over and over again, gone through data, seen your pattern repeat over and over again before you can maybe decide to put in some live funds. But don't rush into the market, put in live funds when you can demo trade. So, True Day. Okay. Now, this is True Day, right? Like I said, it gives you more clarity on what's going on in the market. So, this is a Euro USD chart. Notice these vertical lines. This is all at midnight. This is where I draw the vertical lines. This is the True Day. So, the price action within these levels, or confined within these vertical lines, is one full day. It's another full day, another full day, another full day, another full day. Now, notice what we did, right? See how this was a low? We ran below the previous day's low. This day, boom. And guess what? We started trading higher. So already, by having your charts like this, you can see we've already ran below the previous day's low right here. So going on to the next day, right? We trade above this high. More than likely, they're gonna go for this high. Now, I'm still gonna talk about these levels. Let me not get ahead of myself. But just look at how the price action looks when you're able to put your vertical lines at 12 midnight New York time. You're able to actually see there's more clarity in price and see what's going on. All right. And these are the kill zones. This is during London session. See how it's more volatile, a lot of movement. New York, a lot of movement. And notice how going into Asian session, it just dies off. It's just pretty much not really much going on. This session, you want to avoid trading. This is more likely always going to be in consolidation. Now, liquidity post. Now, this is important. To effectively trade the market, you must understand that all the markets seek every single time, every single day, on every single time frame is liquidity. All the market is doing every time just after liquidity. Always after liquidity. Now, this liquidity comes in form of a previous month, week, day, or sessions high and lows. And also you have engineered liquidity, which is just clean highs and lows. And I'm going to show you this on the chart, so don't panic, because you're probably wondering what's engineered liquidity, right? So, now the same chart, Euro USD. right? So look at, like I said, it goes. Previous days is one form of liquidity. The previous days is low and high. So like I said, remember how it ran. Look how it ran through. Boom. This day's low, taking liquidity. And then it consolidates, and look at how they left. They do this on purpose. They leave these double tops. What they teach in the book, when the market gets to a double top, you sell. Yeah. Look, that's engineered liquidity. They do that on purpose. They leave those clean levels because they already know majority of traders have this idea of double tops and triple bottoms and double bottoms. That's all garbage. I don't care. It's garbage. How can you even backtest that information? It's hard. It's too subjective. Okay? So, whenever you see double tops, those are considered clean highs. Those are engineered liquidity. That's just the market stopping there on purpose, not taking out the high, going a little lower, just so they can rail in some more sellers and then just ram it up their backside. And, yeah. So, here you have it, right? This liquidity right here. We ran below it. And went a little higher, stopped right above this high. And look how it consolidated into Asia session, then London, boom, ran above it. Consolidate again. See how this high was in play. The whole time the market, especially after it ran above this day's high, right? After it ran below this day's low, and then ran above this day's high, it's now targeting liquidity on the upside. Where is the liquidity resting? The first one was here. Here, and look at these clean highs. You see that? They did it on purpose, right? They set it up so they can come there later. So whenever you see an area like this, when the market starts to trade higher, your eyes should automatically go right there, right? Even just notice how today the markets have started to consolidate right below here. I highly believe they're just going to run it through there. If they haven't already done it, they're probably going to do that. So that's how you want to look at the market. You want to look at what gives you bias. It's where is the liquidity resting, right? Have they ran through liquidity and start reversing? Have they ran through some sell side liquidity? Sell side liquidity is on the low and on the lows. Buy side is on the top. So if they ran through sell side liquidity, maybe on the daily chart, this goes for every time frame. But these intraday charts are able to give you more. The intraday charts repeat over and over again, so it gives you more understanding of how the markets operate. What happens on the intraday charts also happen on a higher time frame. But if you look at your charts and you're able to see that the market has taken out liquidity already on the sell side, and then finally broke above a high or a previous day's high, the next target is more than likely the buy side liquidity. Now, if there's a double top, they're probably gonna run for that, right? And look at how they go up here. I love this, right? And then they went right below above it and then dropped. Guess what? Some people consider this a fake out, right? When it goes right up above there and then drops. You have to have market context, understand what's going on. The market is not here for you to win this game. They're here to fuck you up, long story short. So they do these games where, boom, because the books tell you another pattern. This is a triple top. Boom. We've made a high. Yeah, I understand they ran above it a little bit, but you want to see them actually run through it. When they just do stuff like this and run through it a little bit and then start dropping, you want to be a little more fishy because they're probably going to come for another run. Because all this did was just even make more people think this is actually going to sell. You want to see at least like maybe a 10, 20, 30, 50, 10, 20, 30 pip sweep above a high. If they just come and poke it and drop, right, and what they dropped, they took out this liquidity, by the way, and start going higher, they're going to go for it, right? So don't fall for those things. It's going to take time, but you got to stick to it. See, the thing is, us as traders, we're so quick to go on to the next thing. You need to, granted that it's a good mentor or it's a good strategy, you actually need to trade that strategy, see it happen over and over again, or trade the market with a certain understanding. For example, liquidity. If I was to trade the market with liquidity in my mind from the day I started, I'll already be ahead of myself right now. This is what makes the market move. Liquidity. Where's the market? Where's the liquidity? That's all they're seeking every time. Every single time. Where is their stops? Where do people put their stop losses? That's it. So since I've been on both sides of the spectrum, I know I'll put my stop loss, above here. And the market starts trading close to it. It starts selling. I get excited and they run it higher. And maybe it knock me out and it drops. I say, okay, cool. I'm back in the sell. And then now I have my stop loss above here, and then boom, they run. You get it if you've been on that side of the spectrum. It's all about liquidity. You tie in intermarket correlation. You tie in what the dollar's doing, and you also tie it in with liquidity. And you have something to work with. Okay. Now there are liquidity voids. These are pockets in price on charts that has only seen selling or buying. The market uses these voids as true support and resistance in the market. So, liquidity voids, fair value gaps, whatever you want to call it. These are levels where it's only been buying. For example, right here, there's only one up close candle. And then between this candle's low and this candle's high. This candle's high right here. And this candle's low. There's a little gap. Oh, hold on. Little space between those. There's a gap in price. So the market is going to tend to go into that area, rebalance, and go higher. Now, it doesn't have to cover the whole area up, especially for bullish. You don't actually want to see that happen. You're better off not seeing the market trade fully in here and then start reversing. It lets you know how that the market really has more strength behind it. It's actually wants to push higher. But anyways, levels like this where there's a little gap in price, those are the true support and resistances in the market. So it goes higher, so there's a little gap again. The market trades in there, goes higher. It's a little gap between this candle's high, this candle's low. The market goes in there, goes higher. Between this candle's high, this candle's low. It goes in there, pushes higher. See all those little gaps in price? See how it keeps going higher and higher and higher. Such a beautiful, easy trading day, right? This is on a 5-minute chart. This happens on a 1 hour, 4 hour, daily, weekly, monthly. These little gaps and pockets in price, you want to pay attention to those when you see them. They tend to act as support and resistance in the market. If I had known this and framed my trades around this, the importance of me knowing this is so I can frame my trades around these levels, because they'll give me the most probable trades. Including, I got to add the other ingredients, but just focus on these fair value gaps or liquidity voids. These levels are what I consider the real support and resistance in the markets. And I should focus on that instead of having thousands of lines on my charts. The support and resistance. Look, the market is not worried about a support or resistance line that was drawn from 5 years ago, 2 years ago. So get that garbage off your chart, right? You want to focus on what's happening most recently. You want to focus on where there's a gap, where there are voids in the charts. Those are levels that'll give you price movement. Those are levels that'll give you true support and resistance in the market. So, SMT or smart money tool or smart money technique. This is when a financial instrument does not make a lower low as its correlating asset does, or does not make a lower low as an inversely correlated asset makes a higher high. So what does that mean? For example, Euro USD is inversely correlated to dollar. So if dollar was to make a higher high, and then euro fails to make a lower low, that is considered SMT. It shows that there's a shift in the market that's going on. So you want to be paying attention to that, to the Euro USD, because remember, dollar's king. So if dollar makes a higher high and Euro USD fails to make a lower low, ignore that. I don't want to get too technical right now. But essentially, SMT is just when one currency like the dollar makes a higher high and euro dollar fails to make a lower low. Or if we're talking about indices, we can say S&P makes a lower low and US 30 fails to do that. Or NASDAQ makes a lower low and US 30 fails to do that. Pairs that should move each other should be doing the same thing. If they're not, there's a shift in the market. And you want to pay attention because, probably a sign that smart money is probably onto it. Now, talking about SMTs, this is today's trading. Of course, I took this trade, paid off very handsomely. What made me take this trade? I didn't point out where I entered in this trade. I even forgot, honestly speaking. It's on my YouTube channel somewhere. But looking at this is US 30. This is the S&P chart. During London session, see how we made a lower low. Now, these indices should be correlated to each other, which means they should move with one another. When one does something, the other should do the same thing. And when you have a situation where one makes a lower low and the other one fails, right? You want to see this as a sign that SMT that smart money is probably going to get involved in the market because there's been a shift in the market, and this is probably going to be a fake out. So notice how this was actually the low of the day. After this happened, it just kept trading higher and higher and higher. So this is not an entry pattern, just giving you ideas on what's going on in the market, letting you understand what's going on in the market. This is something that is very important. You need to go back in your charts and back test this and see this happen over and over again. You should not overlook this at all. Very essential to trading, especially if you're trading indices. Now, importance of the higher time frame. The higher time frame levels are the monthly, weekly, and daily charts. The 4-hour charts can also serve well for intraday trading. Higher time frame levels have a higher chance of panning out. Reason why is because that's where the banks and all these institutions, that's where they plan out the levels to execute their trades. They're not executing on the 1 minute time frame. They're looking at the higher time frame, and then at those levels they're able to execute. So when you now see something, if you see a daily level or a monthly level or a weekly level, those are levels you want to pay attention to because those are levels where the market's probably going to have a very impulsive and strong move from. Without trading based on higher time frame levels, the trade is not higher probability and just a poor trade execution. At that point, you are just trading a chart pattern with no underlying context or reason for it to pan out. So that's, if your strategy is just, buying in an order block or buying a supply zone, if there's no daily level, weekly level, monthly level, at the very least 4-hour level showing that level is strong, you're wasting your time. You're just playing yourself and trading the pattern. It's going to be a losing trade. Don't do it. Stay away from it. Preserve your capital. And now the importance of lower time frame. The lower time frame charts are not just noise. Do not think this. No matter what anyone from Goldman Sachs or anywhere says, the lower time frame is used to reduce risk and refine entries. Right? So when you put the lower time frame in the right context, how you do that? By seeing what's happening on the daily chart, weekly chart. Is it a daily level? Cool. Now that we have that break of structure, do we have an entry pattern? Whatever your entry is on a lower time frame, that's a more solid and more highly probable trade than you just trading. Let's just say you still use indicators or RSI. If something is oversold or undersold, whatever it is, overbought, undersold, overbought, oversold, whatever. If it's not at a daily level or weekly level, you're wasting your time. All right, that's why your trade's probably not gonna hit. You want to be focused on daily level, weekly level, monthly level. You have higher probability then. Now let's look at what happened today. So this is just, if you traded today, you know that of course I was in this trade and the market really took off. I was talking about it on my Instagram and Twitter, and I made a video on YouTube, I believe. So, long story short, look at this void again. I'm putting everything together. This is a higher time frame. This is a 4-hour chart, not the daily. But it easily could have been a daily. But I said, like I said, at the very least, sometimes when there's if the daily levels are probably unlikely to get traded to, that's when you might want to look at the 4-hour. I wouldn't go lower than that. Now, see this little gap between price right here. Because we had what? This candle's high, this candle's low. Price went in there. Now, if you were trading just based off of this, you would have to put your stop loss below last swing low at minimum. And boom. This is a 4-hour chart if you just trade based off that. This is like a 1 to 2. Now, if you saw this level shaded in, and you now went to the 1 minute chart, which is right here, shaded in, this level, what do we have here? Right? We had two places we could have actually got it. So the market traded. When the market traded again higher, breaking this swing high, you could have got in right here. Well, I really wouldn't get in that trade because there's no gap. Maybe if it came lower in here, there's a little gap, I would have got in. I like to get them based off of a liquidity void or fair value gap. So, but anyways, then here, boom, we have a clear push. Breaking structure. Falls back in within the range. This is all a void. If you look on the 2-minute chart or 1 minute, 3-minute chart, whatever it is, this is a void in price. This is all buying candles. So we drop in there, boom, stop loss below here. And what do? We take off. You see what I have right here? This line right here is the same line right here. So by refining your risk on the 1 minute, look at how much you're already at, like a 1 to 6 risk reward, and you're still right here, knowing that the market is going for this high and this high and this high. Why? Because seeks liquidity. Why? Because these are clean highs. These are highs in the market. The market has already ran out these lows. Right around these lows. And what do? We start, boom, trade it higher, breaking this swing point. So when trades in here, your mind is not going to drop. Your mind should be on buys. And that's what the market delivers. Takes out liquidity, liquidity, liquidity. So once again, look at these clean lows, right? Triple bottom, whatever you want to call it. They do this on purpose. Engineer liquidity. And then they go right here. Look how they bounce out up real quick, giving you hope or giving retail traders hope. This is support. And then they, boom, ran right low, real good. No matter who's here, they're out the trade. And then, boom, they push it higher. Again, this little gap right here. This will be an entry on the 4-hour chart if you're trading that. Boom, ran it higher. Come back down. Now, notice they ran it higher. Yes, they're around these highs, but there's still work left done up here. So work here, here. Still liquidity there. They drop it aggressively, right? And what they do? Boom, ram it up. Their backsides. So, anyways, these are things that would have propelled my trading to a whole nother level by now. But I'm grateful for where I am right now, and the journey is still beginning. But these are things, if I was starting off trading, I'll be paying attention to stuff like this. I wouldn't be focused on indicators. I'll keep my charts. Matter of fact, indicators, no indicators, just price action. Just price action. I'll keep my charts clean and force myself to figure out how to trade based off liquidity, based off of the stuff I just explained here. I'll pay attention to what the dollar's doing at all times, and then frame my trade around that plus my higher time frame level. So this is how you add things together. You look at the dollar, look at what it's doing on the high. You want to break it down, high time frame, all of that stuff. When you break it down, you know what? Now you know dollar's direction. Then you want to focus on whatever pair you're trading, whether it's euro dollar or indices. Let's just say it's the euro dollar. Boom. You break down euro dollar, you find the level on your daily chart, right? So now you have you have the dollar back in your trade. Now you have a high time for back your trade. Then you wait for your entry pattern, and boom, you execute. You execute. And you want to trade something not like a fucking bat pattern or whatever, Superman pattern. Triple tops, triple bottoms, just stop it, all right? And I'm not, like I said, I'm not trying to make fun, but I've been on that side and it's bullshit, right? So you want to find something that repeats, which is, I'll say, break of structure. What repeats in the marketplace? I'll give you a trick right here. Look at this 4-hour time frame. We'll start at the bottom. Market runs out the lows. The lows are gone now. Liquidity is gone. After they do that, after around these lows right here, do they keep going lower? No. It wicks and then boom, breaks the swing point. And what does it do? It creates a gap in price. Where's the gap between this candle's high and this candle's low? The market goes right in there. That's right there is a strategy on its own. You can backtest that over and over again. Why is it not subjective? Because everyone can see this on the chart. You can see the void. I can see the void. But my trend line is going to be different from your trend line if we start drawing trend lines. That's what I mean by objective and subjective. These are more objective because you can see it on the chart. Everyone can see it. But not everyone's thinking the same way. So, boom. This is a gap in price. Boom, you enter there. After it broke structure, one, it took liquidity out, ran higher, broke structure, boom. gap in price. It goes higher. Is there still liquidity to run out? Yes. It drops. What is it? Why is it dropping? All it did was have buying candles up in here. All this buying could have dropped in here, yes, but it doesn't have to. You don't want to see it actually drop and cover when you're on the bullish side of things and the market has a liquidity void. You're better off not seeing it cover every little gap. So you look at this level, you pay attention to what time it got there. Okay, it's London session. It's in this level. Boom, it starts breaking higher. Right? We have it. Look at same exact pattern. Charts are fractal. We have the market drop lower. Boom. Take all liquidity out to the left. And remember, as it dropped lower, guess what? US 30 didn't do it either. So does that add to your trade? The SMT I talked about. So now you know smart money's involved. You know that if you were paying attention today, dollar was already bearish. Right? So let's get out of the way. Dollar's already bearish. Dollar was bearish today. Today's date is, just in case you watch this very later, today's date is July 19th, 2022. So dollar was bearish for today, right? So that was established if you look at it. So now you know that. And the indices is bullish because, like I said, you should have the idea that we already ran through these lows. We've broken structure. We have a fair value gap. We pushed higher. Now we're in this level. We're watching accumulation happen here. Our targets are still up here because dollar's bearish. Now you look on the lower time frame. What do you see? The same exact thing. Boom. Run below here. And SMT happens, which means S&P 500 went lower, but US 30 fell to do the same thing. So automatically, since you're already bullish, you're like, okay, good. You don't just hop in the market. You wait. Boom. We have a breaking structure here. Market consolidate some more. You didn't really drop into any gap after it broke, this structure. Consolidates and boom. Break structure again. This all voids in here. It's a gap. You enter the market here, stop loss below here or stop loss below here, whatever you're comfortable with. By the time you back test, you figure out. Your first target could be here. And look at it. Here. You see where this line is? Where this line is? It's already 1 to 6. Look at if you're trading on the 4-hour chart, you're not even at 1 to 1. And it went way more. It was actually 1 to 20 trades today, actually. You take partials on the way. So anyways, I won't talk too much. There's going to be more teachings like this. I would appreciate if you subscribe to the channel. I need subscribers. I need to know that y'all are enjoying this content. Like it, comment on the page. I'll appreciate it. Yeah. I hope this was insightful. If it was, like I said, leave a comment. Thank you. Talk to you next time. Have a wonderful, wonderful night. God bless.